And no one goes into a deal process hoping to get something mediocre.
Right.
Everyone's hoping for a great outcome. So you can do the things to help shape that process and increase your odds of a great outcome. It's not easy. It doesn't happen overnight. I think people often lose sight of how much of a grind it is.
Hi, everybody. My name's Keith Dee, President of Osage Advisors. Thanks for being with us today on our podcast, The Ins and Outs of Selling a Business. We're really excited to have back with us FitzGerald. Phil, Amplify Consulting Group. Continue our conversation about that pre-planning process, getting you ready, not just your financials, but from a full gamut of everything about your business and yourself when you sell. So, Phil, thanks for being with us. It was a great conversation last episode, and when I was thinking about it, we're talking a lot with clients about the intensity of the due diligence process right now. I mean, 15 years ago, financials, legal, check a few boxes here and shake your hands and have the draw it up and close the deal. Now, and I think it's probably a generational thing as a new group of deal makers or buyers come in from the buyer side, they stress test every aspect of your business, from the financials to your operations, your sales and marketing, your IT, your cybersecurity, your social media. They scrape your social media accounts. They'll benefit. The insurances they'll dissect it into like 5 or 6 sections, right? Property and casualty, employee benefits, pensions, right? Deferred comp, you name it. And they have experts. They don't do it themselves. They have people whose jobs are specifically that little piece of the due diligence process. They're experts in it.
Right.
And as a business owner, especially our clients, right? We're typically, 10 million revenue to 250 million revenue. So lower middle market type businesses, you may not have that big team in place.
Right.
Right. So you coming in, so your job, how I look at your business based on our previous conversations is you try to anticipate and prepare them for some of this so they have the answers readily available to be delivered in a timely manner.
Right. I think that's 100% right, Keith. When you think about the typical lower middle market business, again, many of them are going through an M&A process for the first time and probably the only time. And what I think often gets lost is how much information is needed in due diligence. And there's a couple reasons for that. I think the market has shifted quite a bit in a couple of different ways. The first is the number of buyers. There's so much capital on the sidelines. There's so many different flavors and sizes and shapes of financial buyers than there used to be. And they don't look at businesses the same way that they used to or that strategics do.
Right.
And 2 reasons for that in my mind. One, because there are so many financially oriented firms, whether it's family offices or traditional private equity or what's called fundless PE or
independent
sponsors.
Right.
In a lot of cases, I think what gets lost is that none of them are spending their own money. Maybe a little bit, but generally speaking, all those financial investors are spending someone else's money. Maybe the family office is a different case, but when you think about what happens when people are spending someone else's money, they tend to take a lot more care about it. Because if you think about the small first-time private equity buyer, they need to establish that they know how to do deals. They know how to protect the investment of the limited partners that are part of the equation. And if they get it wrong in due diligence,
they're out of business.
They're out of business, and they will never raise another private equity fund.
And that's what private equity funds are about.
Right.
It's about raising that next fund.
Right.
Right. To deliver results, meet your returns. So to your point. So you're right. That's a great point because the intensity is, like I said earlier, is just amazing, and managing that process. So you're getting the buyer, getting the owner ready or ownership group ready, and family,
right?
Because they're going to be pulled into it as well for that part or aspect, which is a third of the deal. I mean, really, the last third of the transaction process, say 9 months or a year, is all about the due diligence. So if you're not ready for it, or you lag it or delay it, the results could be, dramatically against you.
Right. And I think with a lot of small business owners, what they don't always understand is how much time and effort that process takes, how much work it is beyond their day job.
Right.
So they might work 9 to 5 or 8 to 6 or whatever they do running their business, but then a buyer shows up with 200 questions and they don't realize that those 200 questions aren't optional. There's not a hope that maybe you'll fill in 25 or 30%. The buyer wants all of those answers. A lot of cases where I've worked with clients historically is in understanding what needs to be prioritized, because what you can do first to get the buyer doing their work, answer the big ticket questions, things that are fundamental to the understanding of the opportunity, and then put the team in the background working on the smaller or the longer term questions that take more time and effort. You can't just hope to tick down the list and get things done at a snail's pace. One of the deals I worked on most recently this past year was brought in by a private equity firm. And the reason why I was brought in was because the letter of intent was signed and 6 weeks passed before the first piece of diligence information traded hands. So it wasn't that the seller wasn't serious. It's that they had never done this before and they didn't understand how important these questions were and sequencing them, because as we've talked about before, the buyers being of a different flavor and shape and size than they used to be, they hire tons of outside experts. So now they may have someone who specializes in due diligence around insurance, whether that be property and casualty or workers' comp or anything like that. They specialize in that one little function. And to do their work, they need the documents and the data to analyze.
And they're going to dive really deep.
Right.
Because this PE firm that they're working for does multiple deals.
Right.
And they want to do they want to build their file because they want to get hired for the next deal.
Right.
And if they miss something, they're out. So the level of scrutinization from all aspects of that transaction by those outside consultants that you refer to is intense.
And they're on the clock.
They're on the clock. There's time requirements.
Once you hire them, they're getting paid to do their work. If you make them sit around, you're paying them to not do work. So obviously the private equity folks often try to maximize the benefit and the impact of those due diligence experts and minimize the time they're sitting around waiting.
So, it's something just struck me as you're talking about. So a couple things. One is we're talking to a client, great business. And he wants to run, kind of a limited process. So, he's got 4 or 5 people, 4 or 5 potential, what he considers high quality buyers. And so, we're talking, look, we run a more broad process, but we've run smaller processes depending on how if it doesn't work small, we'll expand it. We're flexible. And when we were having this great conversation and he said something, well, I want to limit it because of the amount of work required. And I said to him during the conversation, I said, the upfront work is on us, right? Once we get the book out, all that work is on us as your advocate out there selling.
Right.
The back end piece, when we sign a letter of intent, is I don't care if you have 1 buyer or 10,000 buyers, it's not going to change.
Right.
Because then you get due diligence, and that's when you really have to be heavily invested with your team to get it done. So it doesn't matter if it's 1 buyer in a small process or 3 buyers or it's the 10,000 buyers. That back end, 80% of your work as an owner is going to come after the LOI is signed.
Right.
And so getting them ready for that, what you do is in your business and Amplify is critical. But that misconception, I don't want to run a sales process. I got somebody I want to buy my business. I just don't want to go through it, invest in that process. It doesn't matter. I mean, at the end of the day, that back half piece, once you sign an LOI, it's going to be intense amount of work for you and your team.
And Keith, I'm sure you see this in your business too. You don't always get hired by somebody who's looking to sell in 2 years and wants to really think about their path and the process. What happens a lot for me, and I'm assuming for you too, someone knocked on the door and now there's urgency. You've got a buyer looking for information to make a decision about whether to make an offer and what offer to make. And the seller who has done no work to think about what the model looks like or put together a virtual data room or anything that might be beneficial in getting that conversation started and moving it a little bit more quickly, now does have that distraction. And they have to decide, will I invest the time and effort to run at this hard at the expense of my sleep, my operations, anything in between, or am I going to dismiss it, as you just said? And in a lot of cases, it may be the only time that they get a chance to have a one-on-one conversation and see if there really is something to do. So I think spending time working through this question of what do I need handy to have a real conversation with a buyer, it's important for every business owner.
Yeah, we believe in the concept of, testing the market, because you don't really know value. You don't know what people are thinking.
Right.
But, to your point is like, I use an analogy in football. I said, you're at the 1 yard line, right? And you spend 10, 20, 30, 40 years or more. I mean, we have 2 clients, 50 years in business, right? That getting over the goal line, that last push is a huge hurdle.
Right.
And you need to be prepared for it. And you need to have the people around you that can support you and help you, I won't say tush push, but basically tush push you over the line, right? I mean,
it's a great analogy.
So, because and without that, someone comes in, wants to buy your business. Say, this is the scenario. They come in, one buyer, you decide, I like to, okay. You get in a conversation. All of a sudden, your mind starts to spin. Your stress goes up, anxiety goes up, and you're into 3 months, 4 months, and 5 months, and I haven't got my letter of intent yet. They keep on asking for stuff, and I give them stuff. I piecemeal it out to them, and this and that, and then all of a sudden they come back with a number and a structure. It's like, what?
Right.
Why? What did I spend all that time with? 6 months of my life on all this stress, and I got this structure. We're going to pay you X amount in cash. We want a big seller note. And then, you say, what am I doing this deal for? I can work for 2 more years and close my business, right? And then I'm financing myself out. And it's like, all that time and effort went for what?
Right.
So, and if they were to, first off, look, from my perspective, if we went to hired a client that had hired you and then did kind of, prepared all this or prepared their mindset for this, it's going to make that next steps smooth out a bit.
100%.
Never going to be smooth, believe me. Right? There's always something under the table, and it surprises. You try to minimize them, you can never eliminate them. Things come up. It's just the nature of selling a family-owned business. But if you could get the mindset working in a place like, okay, I understand why I need it, right? And then my mind is thinking about it. Except by getting hit with it at that moment, you anticipated it 6 months ago,
right?
And you compare yourself.
It's funny, what you were just saying resonates a lot for me. The notion of things changing during the process. They will. They absolutely will. Things will be found that someone is more concerned about, wants to scrutinize more closely, doesn't always look the same from buyer to buyer. But I remember years ago, I worked on an IPO, which is obviously not an M&A deal, but it was one that the memory will never escape me. We went to the organizational meeting, 6 or 7 banks on the underwriting syndicate. We're all sitting around the table. And I'll apologize to my friend who did this, but this is a story that's too good to not tell. He brought out the timeline for the team, so we all knew what we were working towards in terms of filing the S1 and what was going to happen. And this is the first time we've all sat in the room together, lawyers, accountants, and bankers and company. And he gave us a laminated timeline. And I looked at my VP, and he looked at me, and I was a junior guy at the time, and we just chuckled. And the people across the table, what are you laughing at? That's never going to be the timeline.
Exactly.
It's going to change. Something will happen, but he laminated it.
As I say, the goalpost always moves. But as long as it's moving in a direction that works for you, it's okay.
So you have to understand in these processes, every deal deviates from the plan. And the less you can leave to chance, the better off you are in terms of avoiding market disruptions, company disruptions, changes that you can't anticipate. The faster you run, the faster you get the deal done, and the less risk of something disrupting it.
Right. Like a customer canceling an order.
That's a huge one.
Right. Or the buyer has an issue with their business.
Exactly.
There's certain things you can't anticipate. You can minimize as much as possible, but outside influence, things outside your control,
right,
are reasons why you don't want time to drag.
Right.
Because there's a million reasons that things like this recently is the whole tariff thing, right? I mean, that put a lot of people on their heels. You talk about today, no one's worried about it.
Right.
6 months ago, the world was falling. The sky was falling, right? We can't do anything. But something else will pop up at some point in time, some geopolitical event or something within outside your influence. Your major customer just went bankrupt, right? Or they didn't pay you. There's things that you can't control that affect it. But the more you plan, the more you minimize, the more you anticipate, the more you, as you do in your practice, prepare for the blocking and tackling, right, of the deal.
Right.
Is I keep going to these football analogies. The blocking and tackling.
And I'm a hockey fan.
And you're a hockey fan. So next time I'll bring Jim back. He's a big hockey fan too. But the more you do this, the greater chance not only of success, but the value.
Right. The best deal possible.
The best deal that works for you and your family.
Right.
Right?
And no one goes into a deal process hoping to get something mediocre.
Right.
Everyone's hoping for a great outcome. So you can do the things to help shape that process and increase your odds of a great outcome. It's not easy. It doesn't happen overnight. I think people often lose sight of how much of a grind it is. But chipping away at it over time, as opposed to when the pressure is on and the buyer's waiting for answers, at least in my mind, that's very important in establishing a certain cadence to the conversations.
Yeah. So, we've been in kind of there's $2 trillion of dry powder right now, right? So I read this. I forgot the source, and I was at a event last week, and they mentioned it. They're anticipating. Ready for this number? I don't know the size of the deals. They're anticipating 5,500 companies coming to market in 2026.
Wow!
Right
in the U.S.
In the U.S. So if you're selling, you want to get ahead of that, because all of a sudden it's been more of a seller's market. It's going to swing the other way.
Right.
And even if you're in a deep conversation with a potential buyer, they may be looking at 4 deals.
Right.
And if you can't provide the information in a timely manner, they're going to walk.
Right.
We're going to focus on something else because that's where they get the information.
100%.
And you're going to be left, kind of sitting out there. Now we at Osage, when we work on it, we try to, we vet the buyer pool. We
sure.
make sure and, do our stress test and MRI on the buyers as well, make sure they're committed to it as we move forward. We want them to start spending money.
Right.
Right? Lawyers, accountants, everything else. And if you drag on due diligence and they're just waiting for you to get it, and it's like 2, 3, 4 weeks into it and you haven't provided anything, they haven't spent a lot of money, they could easily walk and look at something else. So your process, what you do, getting ready for that, anticipating these things is something that is, every owner should be doing.
I think about that a lot, Keith. When you mentioned 5,500 companies, that's a lot of competition for attention.
Right.
If you're a seller, you're up against all the other companies in your sector, in your market that look even a little bit like you for the attention of the buyers.
Right.
And you might think that, okay, great, a lot of sellers coming to market, there's a lot of capital available, valuations are reasonably good, but buyers always gravitate towards the best assets. Mm-hmm. And if you are not ready for that conversation, they'll move to someone who is.
And that is a great way to segue into thank you for being with us, because that is it. They will move on to some other deal, and you'll be sitting there and have to start the whole process again, which is in nobody's best interest.
Time is not your friend in M&A.
That's right. I say it all the time. So Philip FitzGerald, Phil, like you got to go by, Amplify Consulting Group, thank you so much for being with us today. It's been a great conversation. If you're interested in talking to Phil, you can, Amplify Consulting Group, you can search him on the web and have a conversation with you. And again, my name's Keith Dee, Osage Advisors. Great conversation today. If you enjoyed it, please feel free to subscribe to our YouTube channel. To learn more about Osage Advisors, please visit our website at osageadvisors.com. Any questions, feel free to email me at kdee@osageadvisors.com or pick up the phone and give me a call at 860-767-3273, extension 1001. Thanks again for being with us, and have a great day.